Trump chickened out. At least that is what the Chinese are saying. I mean, that post with the viral hashtag Trump chicken out now has 150 million views in China and counting, after Trump all but caved to Xi Jinping.
As China and the U.S. continue to clash over trade issues, Chinese government-backed investment funds have started to pull back from investing in U.S. private equity firms. These funds, which have poured billions into American businesses in the past, are now looking for safer options in other parts of the world. What was once a key source of funding for U.S. private equity firms is now facing major challenges, as both countries' growing tensions force investors to rethink their strategies. Private equity firms are companies that raise money from investors to buy, grow, and sell businesses for profit. Chinese sovereign wealth funds such as China Investment Corporation, CIC, have invested billions of dollars into U.S. private equity firms like Blackstone and Carlyle Group, helping make private equity a $4.7 trillion global industry. However, as tensions between the two countries have risen, Chinese investment in U.S. private equity has started to slow down. The growing trade war and political uncertainty have caused Chinese investors to rethink their strategies. Some are pulling back, while others are shifting their focus to different global markets. This shift is having a ripple effect on the entire industry, changing the way money flows and shaping the future of international investments. China has made significant investments in the U.S. over the years, especially in sectors like technology, real estate, and private equity. Chinese companies and state-backed funds have been increasingly investing in American tech firms. Some notable examples include Baidu, Alibaba, and Tencent. These large Chinese tech companies have invested in U.S. tech startups and companies, especially in areas like artificial intelligence, AI, e-commerce, and mobile apps. For instance, Tencent invested in American gaming companies like Epic Games, creator of Fortnite. HNA Group. This Chinese conglomerate made a big push into the U.S. tech sector, investing in companies like the major U.S. airline, Hilton Hotels, and even tech startups in Silicon Valley. These investments were partly motivated by China's goal to develop its own technological expertise and gain access to cutting-edge innovations in the U.S. China has also been very active in the U.S. real estate market. Chinese investors, both individual and state-backed, have bought office buildings, hotels, and even residential properties across major U.S. cities like New York, Los Angeles, and San Francisco. Anbang Insurance. One of the biggest examples was Anbang, a Chinese insurance company that purchased several high-profile U.S. hotels, including the Waldorf Astoria in New York City. Dalian Wanda Group. This Chinese conglomerate invested in real estate developments, including the purchase of U.S. movie theaters and hotels. Chinese investment firms have been active in the private equity and venture capital markets in the U.S., helping finance startups and established businesses. Some Chinese companies invested in American companies through private equity deals or by providing venture capital to promising startups. Fosun International. This Chinese investment firm invested in American companies like Club Med, a resort chain, and also in companies in the healthcare sector. Zhongtai International. Another Chinese firm invested in U.S. startups and business ventures. Chinese companies have also sought to invest in U.S. manufacturing, such as through the purchase of American factories and industrial companies. This was part of China's strategy to enhance its industrial capabilities and create more global influence. For example, China National Chemical Corporation, ChemChina, acquired the U.S. chemical company Syngenta for $43 billion in 2017. Fosun International also made investments in U.S. industrial companies. Some Chinese investments were made with the goal of securing critical resources or knowledge. These strategic investments were often in areas like natural resources, energy, and infrastructure that would benefit China in the long term. President Donald Trump imposed high tariffs on Chinese goods. Some of these tariffs went as high as 145%, meaning the cost of Chinese products in the U.S. would increase by that much. This was done to try to put pressure on China to change certain trade practices, like stealing intellectual property and forcing U.S. companies to share their technology with China. When the U.S. puts tariffs on Chinese goods, it makes those goods more expensive for American consumers. For example, if a tariff is put on smartphones, the price of Chinese-made phones would go up in the U.S. This means that regular Americans end up paying more for the things they want to buy, like electronics, clothes, or toys. So, while the U.S. government is trying to pressure China, it also ends up hurting regular people in America by making everyday products more expensive. China doesn't just sit back when the U.S. puts tariffs on its goods, it retaliates. For example, China raised tariffs on American products, like soybeans and cars. This harms U.S. farmers and manufacturers who rely on China as a major market for their products. So, the tariff war ends up hurting both countries, with each side punishing the other through higher prices and fewer sales. The slowdown in Chinese investments in U.S. private equity could actually be a big loss for American businesses, and here's why. Less money for American companies. Chinese sovereign wealth funds have been pouring billions into U.S. companies through private equity. This money helps businesses grow, develop new products, and expand. Without this funding, American companies might struggle to get the money they need to succeed. In the world of business, money is everything. It helps companies stay competitive and keep improving. If China pulls back, U.S. businesses could be left with fewer resources, making it harder for them to grow and succeed. Falling behind in global competition. The money China has invested helped U.S. companies stay competitive on the global stage. Private equity firms take that money and use it to buy companies, fix them up, and help them expand into new markets. If Chinese investment slows down, U.S. companies could fall behind foreign businesses that still have plenty of funding. In industries like technology or manufacturing, where staying ahead of the competition is super important, this could make a big difference. Without the same level of investment, U.S. companies might struggle to keep up. Fewer jobs and slower economic growth. When Chinese wealth funds invest in U.S. businesses, they don't just help companies, they also help create jobs. These investments have been a major driver of job creation across the country. If this investment dries up, there could be fewer job opportunities, especially in growing industries. Companies that can't grow or stay competitive might even have to lay off workers. This can slow down the entire U.S. economy, which means fewer people might have well-paying jobs in the future. Risk of more trade tensions. As the U.S. government blocks or limits Chinese investments, it can make the trade war even worse. China pulling back its investments in American businesses is a direct response to these tensions. If more countries see this and start to hesitate about investing in the U.S., it could make the U.S. economy less attractive to foreign investors overall. That's a big problem because the U.S. has relied on global investment to help businesses grow and stay strong. Losing America's global edge. For a long time, the U.S. has been one of the top places in the world for investors to put their money. But if China and other countries shift their focus to other places, like Europe or emerging markets, the U.S. could lose that advantage. With less investment coming into the country, U.S. businesses might not be able to compete as well in the future. Other countries could start to take the lead, and that would be a huge setback for America. In the end, the slowdown of Chinese investment in U.S. private equity is a loss for America. It means fewer resources for American businesses, less competition, fewer jobs, and a weaker economy. If this trend continues, it could hurt U.S. companies and workers in the long run. The U.S. needs that foreign investment to stay strong and competitive, and without it, the future could look less bright for American businesses.